Investors, holy smokes. Over the last handful of days, the market has managed to tank by over 3.5%. The Federal Reserve shared some troublesome news, and the nation tries to avert yet another government shutdown. But more on all of that to come in a bit. If you're new here, I'm Ari, a dividend investor here on YouTube with a mission to deliver through on the economic insights that you need to be aware of and weekly dividend stock ideas, to which I have exactly that in store for you today in regards to the insights, followed by 7 powerful dividend growth stocks worth your attention right now. With that, let's dive right in. So the market has been sliding all week long. As for my account, also on the rocks and just hit a lower low in quite some time, currently sitting at $116,791.76. Not only is that about $10,000 off a peak from about a month ago when I was above $126,000, but everything that has been happening recently has been called video by video leading up until this one. And no, I don't share that for any sort of clout. I share that because I want you to understand your macros. You're not only going to be able to invest accordingly, but you will be able to avoid the mass hysteria, unwarranted freakouts, and panic selling. And that will inevitably then allow you over the course of time, the longer period of time, to fare very well for yourself financially. After all, Soros said it best. If investing is entertaining, if you're having fun, you're probably not making any money. And good investing is boring. With that, let's now get you up to speed with everything you need to know on a macro level here, going back to a couple weeks ago to the latest CPI or inflationary reading, whereas inflation ticked up to 3.7%, which was much hotter than expected and had investors on their toes. The Federal Reserve would then hike interest rates in their next FOMC meeting. Now, while the Federal Reserve ultimately rendered the decision this past week to leave interest rates unchanged, they did in fact forecast another rate hike before the year's end, and not only that, but Powell once again sang a rather hawkish song for all of us that really rocked the market for the worse.
Inflation remains well above our longer run goal of 2%. In light of how far we have come in tightening policy, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%. If the economy evolves as projected, then the appropriate level of the federal funds rate will be 5.6% at the end of this year, 5.1% at the end of 2024, and 3.9% at the end of 2025. I've always thought that the soft landing was a plausible outcome, that there was a path really to a soft landing. I've thought that and I've said that since we lifted off. It's also possible that the path has narrowed and it's widened apparently. Ultimately, this may be decided by factors that are outside our control.
Now, the most important snippet, if you were able to catch it, was the fact that Powell shared that his baseline scenario was no longer a soft landing. Everything else that was mentioned, from monitoring future data sets to rates remaining elevated for longer periods of time, we knew. Or at least we should have known if we've had our head on the swivel. However, Powell mentioning his baseline changing, in my opinion, is really the classic political priming done to prepare us very slowly for future volatility. Now, hopefully this is nothing new for you if you've been following my channel, because I have literally been saying it for weeks now. And you know what? This is not the end of it. I'm here once again saying more volatility and a larger downturn is very likely to hit us. And on top of all of that, something rather minor that the media will likely continue to blow up for no reason is the potential for a government shutdown. This is unlikely to happen, but will make for a heck of headlines to keep you hooked, so just be aware of them. Now, what does all of this mean for us in the longer term as dividend investors? It means that high quality dividend stocks are right now trading for some pretty steep discounts, and therefore I have 7 growth stocks, dividend growth stocks that is, for you to take advantage of. But understand this, dividend growth stocks essentially are the stocks that are already not at insanely high dividend yields, but have the potential to continue to grow their dividends for you. So this is literally the perfect time to get invested into these dividend stocks and just hold on to them as they continue to grow their dividend. First up, General Dynamics, ticker symbol GD, a stock that I've actually mentioned several times over the last couple of months, when it was trading at lower lows, but still today trading for a solid buy-in price at $222 per share with a PE ratio coming in at 18.3. Now, for those of you not too familiar with General Dynamics, it's a defense contractor that is not quite as vast as, say, Lockheed Martin, but equally as powerful as an aerospace and defense company developing jets, combat vehicles, and control systems. Nuclear control systems, that is. And given their clients being, well, the US government and the alike, a moat-worthy investment, especially with their recent deals, like a $517 million electric boat contract, a $226 million Air Force contract, or a whopping $4.5 billion deal for a security pack. But what's more is the amount of insider activity with director after director purchasing more shares worth of General Dynamics as recently as this past week, as well as hedge funds that have been loading up on General Dynamics as well. Not to mention upside from analysts expected, about 19.2% worth of it, coming up to a share price of $266.13 per share. However, we are here for the dividend, to which General Dynamics delivers with 28 years worth of dividend growth at a rate of 7.83%, which triggers a $5.28 annual payout from their 2.34% dividend yield. And as for this next one, it's an opportunity to literally insure your money, especially for the longer term investors, with Aflac, ticker symbol AFL, which is the largest provider of supplemental insurance within the United States. Now, if you understand the insurance business model, even in the slightest, then you're going to understand the power of getting invested into this investment. Nonetheless, Aflac is trading for just $76 per share right now with a PE ratio at 10.3. But I want you to take a look at their 5-year historical chart here, where you're going to see over 82% worth of growth. Now, if that doesn't do it for you, how about their dividend insights with over 40 years worth of dividend growth at a growth rate of 10.56% with a dividend yield coming in at 2.18%, leaving plenty more room to grow. Now, that's just 2 dividend growth stocks down with 5 more to go here. But before we get to them, I actually want to take a moment to ask if this content is the content you're looking for. And if so, let me know by tapping on that thumbs up button. And from here on out, only more content like this will be coming your way. With that, let's roast Starbucks, ticker symbol SBUX. All right, well, perhaps not roast them, but talk a latte about it. All right, enough with the dad jokes. We're going to talk about this coffee house chain that has over 35,000 locations in over 80 countries worldwide. And hey, it's pumpkin spice latte season here, so every white girl and their mother will be jumping in line, and it's going to be worth it to brew your portfolio up with more Starbucks. Now, right now, it's down by a little over 4% on the year, trading for $94 per share right now after falling from a peak of around $114. I mean, heck, even hedge funds are already way ahead of us here with 500,000 shares purchased last quarter, and analysts raving about it with over 24% worth of upside expected, coming back up to a share price of $117.85 per share. But until its inevitable share price recovery, you're going to be able to enjoy a solid growing dividend, as Starbucks' dividend has 12 years worth of growth behind it at a 10.97% growth rate into a dividend yield of 2.23%. Next up, NextEra Energy, ticker symbol NEE. If you're really looking to quite literally energize your portfolio, then this electric utility giant is a solid bet, as it remains the largest of its kind throughout the United States and Canada. But that doesn't mean it doesn't experience the turbulence of the market, which gives way to greater discount opportunities for all of us, to which we currently have it trading for only $67 per share, which is about 17.8% down year to date, with a rather low PE ratio coming in at 16.7. Yet plenty of upside here forecasted by top analysts, coming to $84.86 per share, which works out to about 25.7%. And while many utility sector plays are down right now, NextEra has some very favorable buy indicators, like the amount of insider trading that has been going on, with about $1 million worth of shares purchased on top of hedge funds that have scored just about 1 million shares of NextEra last quarter. But it's the dividend insights that really get me when it comes to NextEra Energy. We have 27 years worth of dividend growth at a 5-year growth rate of 11.13%, prompting a 2.78% dividend yield to enjoy. Now, as for this next one, a financial sector stock that I can't get enough of and mention quite frequently here on the channel, we have T. Rowe Price, ticker symbol TROW, which has been and remains a powerhouse of an investment advisory firm since its founding. And with its very conservative approach on the technology sector, it continues to return well for shareholders. Yet we can see it in the red right now when it comes to market-specific tech investors who are full of fear, as it's currently trading for $106 per share, which is down from its peak not long ago of $126. Now, regardless, a PE of 16.5, and I'd give it some time before the next launch way back above $120 per share, but would bet my account on it, and so too would their executive team, with plenty of insider buys going on, and hedge funds that are beginning to take slices of the T. Rowe pie. But here's why I'm all about T. Rowe Price. Their assets are all tied into the NASDAQ. So when tech falls, the stock becomes discounted, and then we get our hands on a dividend stock with a 36-year rich dividend history at a growth rate of 12.73% that ultimately shells then out a 4.49% dividend yield. Moving right along, we have good old Texas Instruments, ticker symbol TXN, which may not be your Nvidia, but I'm quite alright with that, as it has proven itself very well as a standout, top-notch, reliable semiconductor play that consistently delivers chips across industry verticals. And right now, Texas Instruments is down by a little over 8%, trading for $161 per share, with a PE under 20 at 19.6. Yet, as tech rebounds and we pivot back into an eventual bull market, Texas Instruments is very likely to remain a key player in the space, so naturally we see plenty of hedge funds who have been loading up on this opportunity, with analysts who are looking into Texas Instruments and seeing a bright future with a forecasted share price of $186.07 per share. It's about 15% worth of upside. And then until then, we get to enjoy this dividend with a yield at 3.06% with a 17-year track record at 14.87% worth of a growth rate. Up next, a home improvement retailer that has just been outbeating expectations for years now and has really only become a very formidable competitor to Home Depot. We have Lowe's, ticker symbol LOW. And since pivoting into what their executive team called an everything home improvement retailer, we have seen plenty of growth from Lowe's. But as of this video, Lowe's has slid from around $233 per share to just $211 per share, the PE ratio at 21.4. So I would say at minimum, keep it on your watch list, especially as this housing market is going to experience, or likely to experience, more uncertainty, which I would suspect pretty soon. But nonetheless, we do have top analysts very optimistic about Lowe's as well, with the share price forecasted at $251.24, which works out to roughly 18.6% worth of upside. And until then, all shareholders can rely on this now dividend powerhouse with 59 years worth of dividend growth at a growth rate of 19.97%. Making for a dividend yield coming in at 2.05%. Now, investors, drop all your thoughts on these stocks down in a comment below. If you enjoyed these insights in this video, you're going to want to check this video out right here. But of course, before you go, remember to tap on that thumbs up button and subscribe to this channel so you never miss a single video.